Okay, why don't we start once again? I hope you can hear me now. Is everything coming through loud and clear? I know we had some problems with the sound before, but if we're coming through loud and clear, why don't I start over again? I want to, first of all, welcome you once again to the Specialist Trading presentation. And for those of you who are unfamiliar with Specialist Trading, we are your premier source for online education in virtually trading just about all of the markets. And this ranges from the stock market to the E-mini markets to the Forex markets. Now, I think one of the things that separates us from all other educational websites or presenters is that each time we give a presentation, we want to leave you with something for totally free so that you can begin using as early as the next day. So we always give you a free tip, technique, or method in which you can use to hopefully elevate your trading, just to show you the sincerity behind how much we really try to teach you how to trade. Now, to give you a little background about myself, my name is Primo. I am the president and founder of Specialist Trading, and I've been trading for a total of 36 years. 16 of those years I was on the floor of the Pacific Stock Exchange, and while I was on the floor, I was a specialist for Donaldson, Lufkin, and Jenrette for 9 years. So I've been trading for a long time. I've seen and traded just about everything. And in today's presentation, I'm going to give you a great technique that you can virtually use for any market, any time frame, and this is the proper way to calculate your position sizing. Once again, this is for stocks, E-mini, S&P, and the Forex market. So you see how versatile this method will be, and it really is a great method because it takes the guesswork out of your trading. There are too many traders that are losing in today's markets, and one of the main reasons is your position sizing, which has to do a lot with your money management and your account size. So I'm going to show you a proper way to calculate your position sizing, whether you trade stocks, the E-mini, S&P, or the Forex markets. Now, before we begin today's presentation, I ask that you please take a moment to view our disclaimer. I'm going to show you a lot of simulated performance, and I'm going to show you some results in using this particular technique, but please remember that we can in no way guarantee that any of these results will be repeated in the future. We're required to show you this, so as you're taking a moment to view our disclaimer, I'd also like to mention, for those of you who are new to my presentations, that I love to take your questions, but please wait till the end of the presentation to ask any questions. I have a little box here that has all your questions coming through, and I won't see them at all because the box is closed. I won't open it till the very last 15 minutes. So this doesn't plan to be a very, very long presentation. So if you have a question, something doesn't make sense or you just didn't understand it, don't worry. Just write it down, and I promise I'll get to each and every one of your questions at the end of today's presentation. Now, if you happen to come up with a question once we've concluded, don't worry, I will also give you a phone number as well as an email address where you can contact us and ask us any questions you have concerning what we're going to be teaching you today. Okay? So, for those of you who just joined us, please wait till the end of today to ask any questions. All right, so here's what you're going to learn today. Once again, I always want to give my students and my attendees free information so that they can start using this right away. We're going to give you two edges. The first one is we're going to go into detail and show you how to properly calculate your risk. Too many traders, once again, are not taking this into account when they're beginning to trade. In fact, they'll go into a trade not even knowing how much they're risking. So we're going to really lay down the format of the guidelines of how to properly calculate your risk. And then we're going to express this in edge number 2, which is a great method for doing that. This is a very simple mathematical method called the RPS method. And I'll go into detail and show you everything. Now, it may be a little wordy once we go over the rules, so don't get discouraged or frightened that you really don't understand it. I'm going to show you a lot of chart examples so that you'll be able to see how it works right away with the chart. Okay? All right, so why don't we begin? Let's first start out with some insights into position sizing. Okay, this is what you have to know when you're really trying to understand how many shares or how many lots of a contract you should be trading. Firstly, too many traders are undercapitalized. I get this question all the time. I'll get an email saying, Steve, I love your strategies and I love the way they work. I have roughly about $800 or $900. How can I apply that to the trading? This is really far too little to start doing anything. I know there are some mini accounts and micro mini accounts where they say you can start with as little as a couple $100. I would say if you're trading intraday, you should have a minimum of $5,000 to $10,000, okay? And if you're holding positions overnight, regardless of the market, this should be closer to $15,000 to $25,000, okay? Now, I can't give you an exact number because it all depends on what strategy you're using and how much risk you're going to take per trade. but we're going to go into detail about that, and then you can decide for yourself. But once again, if you're day trading, regardless of stocks or the E-minis or the Forex markets, a minimum of $5,000 to $10,000. If you're holding positions overnight, regardless of the market, anywhere from $15,000 to $25,000 should be a minimum. Now, here's what we want to stress. It's wrong to use discretion when you're deciding on your position size. Once again, I'll talk to people at seminars or in webinars I give and ask them, how do you decide on how many shares to trade or how many contracts to trade? And it'll usually go back to their last couple of trades, and they'll say, well, I was doing very poorly the last couple of trades, so I'm kind of betting more, so I'm going to bet twice as much so that I can make it all back. Or they'll do the opposite. They'll say, I'm doing very poorly, so I'm just going to trade, the bare bones minimum just to see if I can do all right. And this is basically just guessing how many shares or contracts you should be trading. We want to get away from that. So we're going to introduce the RPS method, which is a simple mathematical formula, but it must be used prior to every trade. Now, in the beginning, when I give you the rules today, excuse me, you may say, well, Steve, I day trade, and this is too difficult to figure out. I can't put together this mathematical formula when I'm making split decisions. That's okay. It may seem a little difficult in the beginning. After a few times of practice, maybe a few days or weeks, you'll be able to figure this out in instants. So don't worry if it's something you feel it's going to take too long before you intraday trade. The beauty of the RPS method is that it automatically decides how many shares or lots to trade. This is the beauty of it. And the edge we have at specialist trading is that we really want to have clear-cut ideas. We want to have strategies that are 75% rule-based with maybe 25% of discretion allowed for trading. But we don't want to have any discretion or guessing in our trading. We want it based off of a plan. So by adding structure to your trading, you're taking that guesswork out. So we really want to get away from what most people do, and they're really just guessing, and then they're hoping and wishing that it all works out. So when we say discretion in our strategies, we mean that these are qualified decisions based on things that you've seen in the past and off techniques and methods that can either make your trading more conservative or more aggressive. But in no way do we mean that when we have discretion in our strategies or our techniques that we're letting you guess 25% of the time. That's not what we're talking about. All right, so let's talk about calculating risk with the percent of capital. All right, the first thing we want to do is we want to make sure that we have an adequate amount of capital. We talked about that. What we feel, in our opinion, is the minimum for intraday trading and the minimum for holding positions overnight. And then we want to talk about the risk per trade. I know you've probably heard this before, but we really want to stress, especially for beginning traders, that you should not risk more than 2% of your capital per trade. Okay, so if you have $10,000 and that's how much you have just to trade with, then your risk per trade should be no more than 200. Okay, and conservative traders will want to include the slippage or the spread included on that $200. So they'll take that into account as well. So we realize that there are some advanced traders that have been trading for years that say, well, Steve, I risk anywhere from 3 to 5%. Well, I've been trading for 36 years, and I roughly risk only 1% of my capital per trade. So this is something that really needs to be taken into account because down the road, it's just natural that you may go into a series of losses, a small drawdown. And so by keeping your risk percentage small to roughly about 2%, this will sustain you, and this will keep you going throughout that tough period so that when your strategy gets back on track, you'll still be able to trade. But most people, they start risking 5%, 10% of their capital, 20%, and then that's why most traders, 80% of all traders, are basically they have to fold, they have to quit trading after the first 6 months because they're not using this proper rule. So we would say no more than 3%, roughly on average about 2%, and if you can, risk really only 1% or less of your account per trade. All right, so let's talk about stocks now. Now that we know and we've gone into the insights about how much we should be risking on average per trade, okay, this is per trade. This is not how much we should have at risk if we have different positions, but we should only have per trade 2% or less, really, of our excuse me, account at risk. Let's talk about how we can use the RPS method for stocks, because the RPS method is going to be a little bit different for stocks in opposition to E-mini futures and the Forex markets. All right, so here's the position sizing formula. You may want to copy this down. Don't worry if it doesn't make sense right off the bat or it's a little confusing. I'm going to show you some charts that'll bring it into light and make it a lot simpler. Rule number one, as we just stated, you want to determine the 2% risk amount of your capital. So you have to really be honest with yourself and say, how much capital do I have working with? Okay, do I have 10,000? Do I have 25,000? Do I only have 5,000? And then say that per each trade, I'm only going to risk 2% of that, however that account varies. Secondly, extremely important, when you get a signal that is generated to either buy or sell, you must decide in advance where your stop placement is going to be. Okay, this is putting structure to your trading. We cannot go into a trade without ever knowing where our stop's going to be. You have to know that even before you would know where your entry is going to be. So you must know where your stop is. This is going to be a factor in determining the formula. All right. Rule number three. Now that we know our stop and we know how much we're risking per our account size, if we were stopped out, what would be the total amount of points lost? Okay, and we're looking at stocks now. Okay, so if we entered at point A and we got stopped out, the trade didn't work out and we got stopped out, what would be the number of points lost? And the reason why we emphasize points is because the stock formula is a little different, based a little bit different than the EMINI and the FOREX formula. This is based off of points. All right, so now that we know how much points we would be losing if we happen to fail on this trade, we want to divide the 2% dollar risk amount, okay, whatever it is, by the total stopped out point amount. All right, now don't worry, it may get a little confusing. I'm going to show you exactly what that looks like on a chart. And once we divide these two figures, we're going to round off to the nearest number for the proper position sizing. In other words, this will tell us how much in advance, before we even enter the trade, how many shares we should be trading. Let's show you a simplified way of what this formula looks like. Okay, this is the RPS method. R stands for the 2% we are risking per our amount of capital. Okay, and as you see, we place the R down here. P stands for the point loss if we were stopped out. Okay, so once we have these two variables, we divide R by P, and this will give us S, or the size or the number of shares to trade. Now let's see what that looks like literally. Let's take a fictional account size here of 100,000 just to make it easy, just to use a big round number. Let's say your account is 100,000. Right off the bat, we know we're only going to risk on average 2%. So R equals 2% risk dollar amount of capital, which means we're risking $2,000 per trade. That's how much we have to work with. All right. So we look at our setup, and we see that where our entry would be, as opposed to our exit if we were stopped out, would be a point loss of 3¼ points, or 3.25. All right. So this is R, this is P. R equals 2,000, P equals 3.25 points we would be losing. So we divide 2,000 by 325, and that comes up with our size, or number of shares to trade, would be 615. So going into the trade, we know we're going to enter to buy or sell, whatever the signal is, with only 615 shares. Okay, and this will vary due to your account size. Your account may grow in size. Hopefully it'll grow in size, but if it goes lower, it'll vary. And as you change your dollar risk amount, say you decide to only risk 1%, this will also change. So this will, you see how you kind of have this ebb and flow on how many shares you will be risking. Now let's see what this looks like if we had a different account. Let's say we bring it down to size and we have a $25,000 account. Okay, well R equals 2% dollar risk amount of that account, which is $500. So that's all we're willing to risk per trade, $500. We're not going to hold on to a position and hope that it turns around. We know that at the worst, we're going to lose $500 per trade. Now, we come up with P in the formula. P equals the point loss if we were stopped out. So how many points would we lose on this particular trade? Well, this particular trade, we would lose 5 points. Okay, according to the structure of this signal that was generated, we are risking 5 points. So we've come up and defined what R and P are. R is $500. P is 5 points. We divide 500 by 5, and that gives us S, which equals 100, or the number of shares to trade. So in this particular setup, we know in advance that we're only going to trade 100 shares. You see how simple that is? But we're adding structure now to our trading plan, and we're no longer guessing. We're no longer, acting like a leaf at the mercy of the wind, saying, "Boy, I had a terrible week. I'm going to bet more. I'm going to trade twice as much as I usually do," or vice versa. we have a structure here that we're following and that we're hopefully going to keep us in line and get us back on track. All right, so let's look at some examples here. Let's look at, now these are older charts, and the beauty of this is that we don't have to look at a current chart because we're more concerned with the formula and how this works. So usually when I give my presentations, I like to use very current and updated charts, but we don't really concern ourselves with this. We're more concerned that you understand the formula. So I'm kind of cherry picking these really nice scenarios so that you fully understand how this process works, okay? Here's a $25,000 account, okay? Let's say we have $25,000 to work with, and we have a signal in win to go long. All right, now the first thing we want to do is figure out what R is. R equals 2%. If we're using the standard 2% risk, 2% of $25,000 equals $500. So we defined what R is. Now we have to define what P is. P is the points we're going to be losing if we get stopped out. So in order to do that, we have to have a strategy. We can't just trade discretionarily with no idea what we're doing. This forces us to have a plan in place or some type of methodology. So if we're going to be entering here, if our signal says for us to enter here, where would our stop be? Where our stop, let's say, would be at this point, okay, at the low of that bar. So we have to figure if we entered at that point and got stopped out below, the amount of points we'd lose would be 1.85. So that's P, 1.85. Now I guess you can figure out what S is. We simply divide R by P. We divide 500 by 1.85, and that gives us the share size, which is 270 shares. So we now have 270 shares in which to go long win if we get a signal trigger. And you would have gone long, and you could see how you would have made some nice points here in win, roughly about 5 or 6 points with being long 270 shares. Okay, see how simple that is. This is the standard way to use this formula for stocks. Okay, R divided by P equals S. R is the risk amount of your total capital, which is 2% roughly. P is the amount of points you would be losing if you're stopped out, and then you simply divide R by P, and that gives you the share size. Okay? Now, let's move on to the E-mini S&P, because even though it's the basic same format, there's a few little things, a few variables here that are different for trading the E-mini. But we can still use this if we're holding E-mini positions overnight or if we're day trading. So let's look at the rules once again. They're very similar, but we'll go over them real quickly. First of all, rule number 1, you want to determine the risk amount, which is roughly going to be 2%. Remember, you can probably go up to 3%, no more, but we want you to actually be closer to 1%. All right. Once you do that, once you figure out the risk amount, what you want to do is you want to decide your stop placement, just like in stocks. You need to have an idea or a plan in place where you know you're going to be stopped out. All right. Once you decide that, if you were stopped out, what would be the total dollar amount loss per contract? Remember, with stocks, we figured what the point loss would be, but with E-mini and with the Forex markets, we want to know what the dollar amount is going to be. Okay, so if we lost 5 points, what would that come to in dollars? If we lost 10 points, what would that amount to in dollars? Okay, so now you simply divide your $2 risk amount by your total stopped out dollar loss, and this will give you the number. You round this out to the nearest number, and that will give you the calculation for how many contracts to trade. Very similar to stocks, but now we're interested in the dollar loss amount. All right, so here's what the formula looks like. R equals 2% risk amount of your capital, whatever amount of capital you have. P equals the point dollar loss if stopped out. So whatever amount of points you're stopped out, what's that dollar loss? How does that calculate into dollars? And S is simply R divided by P, as you see here. That will be the size or number of contracts to trade. All right, so let's take, once again, a fictional $100,000 account for trading the E-minis, okay, just to make it easy. What's R going to be? R is going to be 2% of that. What's 2% of 100,000? Once again, it's $2,000. So we know that each trade, each signal we have, we can only risk $2,000. That's the most we'll lose on that trade. All right. If you want to lose less, place your risk amount, dollar amount at 1%, or maybe half of 1%. Okay. If you're a little bit more aggressive, I would say no more than 3% of your total account. All right, so now what does P equal? Well, P equals the point dollar loss if we're stopped out. So our stop comes out to 4 points, let's say, below our entry. All right, now if we got stopped out losing 4 points, what does that calculate to a dollar amount? Calculates to $200 if you're trading the E-mini. So P equals $200. So now we want to divide R, which is 2,000, by P, which is 200, and that gives us S, or the size or number of contracts to trade, which is 10. So on this particular signal, you were allotted 10 contracts to trade. Okay, and you could have totally bought 10 or sold 10, and you would have been in line with this RPS formula, provided you have a $100,000 account. But let's get down to reality. Let's say you have only a $20,000 account. Well, that's okay. We use the exact same formula. R equals 2% of that, which would now equal 400. So you know that on any setup, any signal generated, you're only going to risk 400. That's the most you'll lose per trade. All right. Now you have a setup. You must figure out in advance where your exit is going to be. You cannot go into a trade without knowing where your exit is. So let's say your exit is 3 points. That's where you'd be stopped out. Well, what does that transfer over into a dollar amount? In the E-minis, that comes out to $150. So 3 points equals 150. So R would equal $400. That's 2% of your capital. P would equal $150. You divide R by P, which equals S, or the size and number of contracts to trade. So in this particular setup, you would be able to trade 3 contracts and being in line with the RPS method. All right, let's see how that looks in the chart form here. We're looking at a 2,000 tick bar chart, but it doesn't matter. It could be a 5-minute chart, it could be an hourly chart, daily or weekly chart. Does not matter. We have a $15,000 hypothetical account. All right, so the first thing we want to do is figure out what R is going to be, or our percentage risk of each signal per trade. And so R would equal $300. If we're using 2% as our threshold, R equals 300. That means whatever the signal is, that's the most I'm going to lose per signal. All right, now we have to figure out where our entry and exit points would be if we were wrong in the trade. So let's say we wanted to go short the E-mini at this point. All right, now where would our stop be? Well, our stop would be up here. All right, once we get above that pivot. Okay, so we know that prior to entry, and so we simply say, how many points is that? Well, that would come out to 2 points. All right, well, we're not interested in the points, we're interested in the dollar amount of the points. So 2 points equals $100 if you're trading the E-minis. So R is 300, P is 100. We simply divide R by P, which gives us our contract size, which is 3 contracts. Okay, 300 divided by 100 equals 3. So we know that we can go short 3 contracts, but only 3 contracts, no more, using the RPS method. And so the trade would have gone our way just fine, and we would have been short using 3 contracts with this method. What if we used a different stop? Okay, a lot of people say here, well, what if I have a larger stop? What if I really, like to give myself a little bit more room in these trades? Okay, let's look at the same trade where we had these parameters for a $15,000 account with this particular stop. What if we still wanted to enter at the same spot, but we wanted to place our stop much further back just to give us some more room to let the trade unfold? Okay, well, R will still equal 300 because we're only basing it off our account size. So the stop has nothing to do with what R equals, but P is based off of the stop. Now P is based off of how many points you would be losing if you got stopped out, and then you transfer that over into monetary figure. So 3 points equals $150. So once again, we divide R, which is 300, that's how much we're risking, by 150, how much we'd be losing per point, and that comes out to 2 contracts. All right, so if we lost 3 points and we had a $15,000 account, we could trade now 2 contracts. So the trade still worked out in our favor, but because we gave ourselves more room, we gave ourselves a little bit more risk involved, we can only trade 2 contracts. So once again, do you see how this puts structure to your trading, how you have this kind of ebb and flowing depending on where your stop is going to be and depending on how high or how large your account size is. Okay, now, this will all be changing once again, also determine on how much you want to be risking per your account size. Maybe 1%, maybe 3%. But this is a beautiful way of adding structure to keep you in line with the market. This is a great money management technique. Once again, you can start using this as early as tomorrow if you'd like. And let's see how the same formula works with the Forex markets, okay? Now, we showed you how it worked with stocks and how it worked with the E-mini. The Forex markets are basically the same, so I'm not going to spend a lot of time going over these rules. They're the exact same thing as you would have done with the E-mini, where once again, if we're stopped out, what would be the total amount lost per contract, okay? So we want to know, if we're stopped out, what the dollar loss is. And so if we're stopped out with a 100 pips loss, what does that transfer over into dollars, okay? It could be $1,000 depending on which currency pair you're trading. And you just apply the same formula as we see here. R equals 2% risk amount of your capital. P equals the pip dollar loss if you're stopped out. And then you simply divide R by P, and it'll give you the size or number of lots to trade. If we look at, once again, our fictional $100,000 trading account, we're risking 2% once again, which will give us $2,000 to play with on this particular trade. P equals our pip dollar loss if we're stopped out. So let's say we placed our stop loss 100 pips away. Well, let's say if we're trading the euro dollar, this would come out to a $1,000 loss. So we're risking $1,000 per this one trade if we're stopped out per 100 pips. So what we do is divide 2,000 per 1,000, and that comes up with 2. So this is the number of lots we can trade if we're trading this particular Forex currency pair. It's the same thing we did with the E-mini account. If we went down to a smaller account, exact same thing. Again, we use the same structure. Our 2% risk amount comes out to $400 now because we have a smaller account, so we can only risk $400, which is 200%, which is 2% of 20,000. If we get stopped out losing 100 pips, this once again is $1,000. Okay, so 100 pips equals $1,000. So what do? We divide R, which is 400, by P, which is 1,000. 400 divided by 1,000 equals negative 0.40. Someone would say, well, Steve, what is that? Do I trade one contract or what? Basically, this is telling you you can't take the trade because we're not even making up a size large enough to equal one lot. So right off the bat, the beauty of this method is keeping you out of the trade because your account does not fit. Either your account size or how much you're risking or where your stop placement is. So rather than adjust the strategy to fit your needs so that you can trade it, just stick with the strategy. If it says this is where you should enter, this is where you should be exiting, and you can't come up with a viable number of lots to trade, then basically this formula is keeping you out of the trade. That's what money management does. So many people think that money management is something that is determined by how much you're going to be losing or where to place your stop. Really, money management, its true meaning is deciding whether you should be trading or not. So this real simple formula basically decides how many shares you should be trading or how many lots, and then it even decides whether you should be in the trade or not according to your account size parameters. All right, so let's look at a fictional trade here in the euro dollar. Let's say we have that large hypothetical $100,000 account. Okay, first thing we want to do is find out what R equals. R equals 2% or 2,000. Remember, these are the standard benchmark. If you want to use 1% or at most 3%, but we would stick with 2% if you're using the standard benchmark. So you have $2,000 to play with on this particular trade. Now we want to figure out what P is. That's the pip dollar loss we would have if we got stopped out. Well, we have to figure out structure to our trade. So where would our entry be? Our entry would be here, and if we entered to this point on the daily bar, where would our stop be? Our stop would be down here. Okay, that's fair enough. How many pips would I be losing? That comes out to 200 pips. Okay, well, 200 pips, but we need to know what that transfers over into dollars. So 200 pips trading the euro dollar comes out to $2,000. So how do we come up with our lot size? We simply divide R by P, and that gives us S, which is one lot. This means we can trade one contract of the euro dollar for this particular setup. And had we entered, we had a nice trade. We would have made over about 200 pips on this particular trade in the next 4 days. Now, things to remember here. Never ever use discretion when you're deciding on your position size, okay? Most people, when they decide, I would say the majority of people deciding their position size just guess. You know, they'll wake up feeling lucky or good today, so they say, I'm going to bet a lot. I have a really good feeling about my trading today. Or they'll come in very negative or scared because they've had a series of losses, and they'll bet far too little. And they'll bet maybe the minimum, bare bones minimum, when actuality their account would allow them to trade maybe 500 shares or maybe 3 or 4 contracts. So never use discretion. Use this formula. And first of all, make sure your trading is adequately capitalized. Too many traders are trading with accounts that are too small. Okay, you need to have minimum of 5,000 to 10,000 for intraday trading and 15,000 to 25,000 for holding positions overnight. On average, you should risk only 2% per trade. This is the standard benchmark. If you want to risk less, that's fine. That's even better. Once again, we have a number of advanced traders that like to risk 5 or 7 or 10%. We strongly disagree with that. We say at most 3%. Okay? The RPS method is a simple mathematical formula that must be used prior to every trade. Now, I know a lot of you may have been seeing this right now and said, boy, I don't think I'll be able to come up with this fast enough trading the EMINI the way I do. I trade it, using tick charts, and it's too quick. Don't worry. After practice, you'll be able to do it. I do this in my head now, and it's easy to do. After some time, you'll be able to figure it out very simply. Okay? The beauty of the RPS method is that it automatically decides how many shares or lots to trade, and that is our edge at specialist trading. By adding structure, you take the guesswork out of your position sizing. We never want to be involved in anything where we're trading, where we're guessing. Okay? Pretty much, if you're guessing in anything, you're basically saying, I don't know what to do. And you should never be involved in trading coming in with that mindset in the first place. You should know exactly what you're going to do, where you're going to be getting in, where you're going to be getting out, how much you'll lose if you get stopped out, how much you'll make if you have a winning trade. You should know this in advance to actually pulling the trigger. So we want to take guesswork out. This is why I believe 80% of most traders lose all of their trading capital in the first 6 months because they're guessing too much. So take that out of the equation, and you'll really hopefully elevate your chances for success. All right, so let's recap here. What did we share with you today? What are the 2 things we gave you in this presentation? We gave you the first edge where we talked about how to properly calculate your risk, how much you should be risking per trade, and then we put that all together with the RPS method, a simple mathematical formula that is designed to take the guesswork out of your trading. Now, here's the most common, whenever I've done this presentation, people love this presentation, but here's the most common question I get right afterwards. It's like, Steve, I love this, but I haven't been trading long enough. I'm a beginner, or I don't have a sound strategy yet. I've just pretty much been guessing or trading discretionary when I trade. I don't have any idea of where I'm getting in or where to place a stop. As we stated, this is what you need. You need the structure, not only to use this RPS method, but you need the structure in order to be on the right track for trading. So, if I can take a few minutes, this is what we provide at Specialist Trading. This is what we do. As I stated in the beginning of the presentation, we are your premier online source for education. We provide you with the tips, techniques, and most importantly, the strategies that I have accumulated in my 36 years of trading. If you're looking for strategies in the stock market, the EMINI trading market, or the FOREX trading market, this is what we give you. Each one of our programs comes with upwards of 10 specific strategies for trading those markets. Now, one of the things we have to admit, if you decide to become a premier member, meaning that you purchase the entire suite of these upwards of 10 strategies per market, it can get very expensive. So what we have most recently done is that we've offered individual strategies for especially the attendees. And there's one of our best strategies because it transfers over into every market. Virtually stocks, E-minis, ETFs, and the Forex markets. It's strategy number 4. It's a great, great strategy. And this strategy in itself, priced at $695, is really inexpensive. Well, we're reducing it even more than that, down $200 to $495 for all the people attending today. Okay? This is an online course. You get instant access. You don't have to wait for something to be shipped to you at all. You can be on the course in the next 15 minutes if you'd like. This comes with detailed instruction. We give you all the rules for entries, exits, and stops. We provide you with signal alerts. If you're looking at daily bars, we tell you where to enter and go long and short the next day. And we also provide you with weekly video trading lessons. Very similar to the trading lesson I gave you today. Well, each week I provide you with another trading lesson that I've learned in my last 36 years, hopefully to elevate your trading. Now, for you MetaStock users, we give you a free add-on which automatically generates the buy and sell signals on your chart. So this is another great thing you get for that low, low price. And then lastly, you get my private email address. You can access me at any time through email and contact me, and I'll answer your questions as soon as I can. Most of the time I'll answer them within the next 24 hours. Okay? So this is a great deal. Once again, let me show you some examples of how well strategy 4 works. Remember, it works in any market, in any time frame. And here's just a few examples. These were signals that were actually generated for our stock traders. Here's a short signal using strategy number 4 in Apple. This was generated on the 12th of February, just a little over a month ago. And had you used our conservative version of staying long this entire time, you could have gained over 32 points in the month of February. Okay. Now this also applies over into the EMINI. Just about a week or two ago, on a 5-minute chart, you would have generated a buy signal to go long the EMINI, as you see here at this point. And if you stayed in using our aggressive version, once again, you could have held on for about 5 points for the remainder of the day. Lastly, we also issue signals on a daily basis for our Forex traders. Now the euro-yen has been going straight up. A lot of people were saying, boy, I really missed that move. Well, on the 9th of January, a couple of months ago, we told all our members to go long the euro-yen. Once again, if you wanted to trade this aggressively and stay in for as long as you could, you would have had over or close to 900 pip gain. That's an amazing feat in just about a month or so, just off of this strategy number 4. So it's a really great strategy. I use it myself. As you can see by all the gains that were just racked up in these 3 examples, they would have paid for the strategy multiple times over. So it's a steal at $6.95. We're discounting it down to $4.95 for all the attendees today. But that's for a limited time only. So you must take advantage of that in the next 24 hours roughly. So if you want any more information concerning what we do at Specialist Trading, you can go to our sister site. This is where we actually promote and sell our individual strategies. That's at protraderstrategies.com. And if you'd like to speak to our senior sales rep, his name is Don Jans. You can contact him by emailing him at donjans@protraderstrategies.com. Or if you'd like to speak to him or anyone else, you can call us at 310-844-7220. So there's lots of ways to ask us any questions about the particular strategy, or if you didn't understand something about the RPS method, anything we talked about or anything we have on our website. Now, as promised, we are going into the question and answer portion, and I want to thank you all for waiting, and I apologize for being without sound there at the beginning. We had a little technical difficulty, but I'm glad you were able to hear it all now. Let me see some questions here. Carlos asks, where are you getting the points from? Well, we're getting the points from if we use our aggressive version. So if you use the standard entry but used an aggressive version, which we talk about in our classes, these are advanced methods for staying in the trade longer, you would have been able to generate those amount of points. Now, once again, we have all of our strategies are rule-based, but we give you that 25% discretion to decide if you want to trade aggressively or conservatively. So if you wanted to trade the conservative method, you most likely would have gotten out within the next day or two for a quick gain. This is what a lot of traders do. I know I trade this way most of the time, but we have other traders who like to stay in for as long as possible. So one of the ways to do that is by using our advanced techniques for holding on, and we explain this in the course and all our videos as well. Let's see. Canoe asks, if trading one contract is okay to add one more if go against. I'm not sure if trading one COT, if that's what you mean by contract. We don't really talk that much about Canoe about adding on to positions. I know a lot of traders like to do that. We have spoken about it before, but if you're, remember, you have to make sure that these parameters are in place. If your account size counts for it, and if you had some structure, we don't just want you blindly saying, well, I've got a nice profit here, and I'm just going to buy another one. We don't want that. We have to have some structure in our account. So we don't want to just be, once again, just guessing and thinking that you have a winner and then buying another one. You have to have another, stop placement as well, and you have to know exactly where that's going to be. And if you follow those rules, then I assume that it would be okay to add to your position. Okay. Ted's asking, is this webinar recorded? Yes, it is, and I have to apologize. The first 5 minutes may be blank or maybe of me talking to myself where I repeat it over again, but don't worry, it is being recorded because we had those problems in the beginning with the sound, all right? Abala asks, when you get an arrow, where will your stop be? Well, this is what we teach you in the course. See, we can't give away those rules because it wouldn't be fair. This is one of the proprietary things we teach you, where to place your stop. Now, we have upwards of 4 to 5 different areas, depending on if you want to trade aggressively or conservatively, of choices for you to place your stop. So we can't just give away that information freely. then you might as well just give away the strategy for free. At $4.95, trust me, at the examples you just saw, it's a great strategy. If I have a $12,500 account and ever risk 30 pips, so I can just trade 0.12. If you're using 2%, 12,500, 2% of that would be $250. Okay, so 30 pips. Let's say you're trading the euro dollar. Okay, that would be roughly $300. So yeah, if you're trading 300 pips, and now you may want to go to 3%, but I would say you can use no more than 3% of that account, which would basically come out to $375. So that would just basically say you can trade just one contract. Okay, so if you're trading 12,500, 3% of that comes out to 375. Okay, now 30 pips. If you're risking 30 pips, let's just say that would roughly be $300. So 375 divided by 300 would give you 1.25. So you can basically trade one contract. Okay, but we really would like to see you get a higher account size, or else keep your stops to a minimum. Maybe if you can find a strategy that would only risk 20 pips, okay? If you had that, and then you'd be able to grow your account, and then once your account got larger, then you could apply more contracts, and you could have even a smaller risk amount. So I would say with this, you would have to risk 3% at the very most, and you can only trade one lot, okay? I hope that answers your question. But you see, just by the simple rule, and by the simple method, I should say, how you're adding some great structure to your trading now. Someone with a $12,000, $500 account would say, well, I'm going to trade 5 contracts or 5 lots, and it doesn't fit into this formula. So what you're saying, Octavio, is if you risk 2%, you cannot trade, right? That's what we said a little bit ago. If you risk 2% of a $12,500 account, that would come out to $250. And if you're losing 300, it wouldn't compute or wouldn't add up to one contract. That's why we said you would have to risk 3%, but no more than that. Okay? If you had the 3% threshold, it would allow you to trade one, depending you had a 30 pip loss. Okay? What I would say is either try to increase your account or use a strategy that has less risk, maybe 15 or 20 pips. Okay? But this will keep you alive. See, we're not trying to, keep you from trading or keeping you out of the market. We're trying to bring some structure to your methodology so that it will sustain you. The reason why most people get blown out is because they don't have any structure. So this free tip we're giving you today hopefully will add some structure, will get you on the road to success. That's what we're really trying to do, make sure that you're able to trade 20, 30, 40 years down the road. Okay? So this is the type of thing that we really want you to do. Once you become a member, if you watch all of our videos and you learn how to, we provide you with all these weekly videos and all these different tips and techniques and things on a weekly basis, and we have them archived for you. Many of these questions and everything will be answered. The rules and all the structure are in those videos. So I would suggest going back, if you're a member, and watching all the videos as much as you can before you start to trade, because this will answer probably the majority of the questions that you may have. Okay, so try to learn as much from the videos as possible before actually trading, and this will really get you on board. Okay. Any other questions? Once again, I appreciate you waiting to the very end, and sorry about the sound problems we had in the very beginning. Remember, just let me go back really quickly. If you're interested, let's see. This is the promotion we currently have for the strategy number 4. You get all these things for the low price of $4.95. We're reducing it by $200, even more than the already low price. So you saw through the examples how well it works. I currently use this myself. It's a great strategy whether you're trading intraday E-mini or whether you're trading daily charts of the Forex or intraday stocks. It doesn't matter. It's a really great strategy because it transfers over into any market in any time frame. So if you have any questions, if you're concerned about taking advantage of that, which we strongly suggest because it's only for a limited time, talk to our senior sales rep. That's Don Jans. Here's his email. Once again, you can contact him at donjans@protraderstrategies.com or simply call 310-844-7220. Thank you so much for joining us. We look forward to seeing you next time, and best of luck with the RPS method. Bye-bye.